Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking at timeframes and trading windows, maximizing opportunities with overlap. Although these two subjects are separate, by looking at them together, we hope you will see the importance of combining them in one section. When it comes to timeframes, new traders are often confused about which timeframe to trade and why. So let's look at the different types of timeframes and traders who prefer to use them. You will most likely be trading on a short-term, medium-term, or long-term time frame, depending on your preferences including your strategy. Lifestyle and the size of your trading account may also factor in. Everybody is different and some traders may use one time frame or a combination of all three. This can add to a lot of confusion for new traders when they begin to develop their trading strategy. Many new traders tend to want to be in and out of a trade very quickly, which means they fall into the group known as scalpers. Scalpers tend to use the 1 to 5 minute time frames. Other traders tend to want to look for long-term trends, but do not want their trades to roll over from one day to the next, in which case they might prefer to use the 15-minute to 1-hour timeframes. These are also known as intraday traders and larger professionals, including institutional traders, who will have a longer-term view and look at the 4-hour timeframes to daily to weekly and even monthly. These are commonly referred to as swing traders. Scalpers may only be in an active trade for as little as 1 to 2 minutes, whereas day traders might be in a trade all day long. Institutional and long-term or swing traders might be in it for days, weeks, months, or even years. One of the reasons why trading can be inherently difficult is because all of the traders have a different idea about where the price of a pair is heading based on various timeframes that are used by various groups of traders. One of the reasons why trading can be inherently difficult is because all of the traders have different ideas about where the price action of a pair is headed based on the various timeframes they are using. Therefore, the majority of them will be trading at odds with each other, not only within their own time frame, but within other timeframes as well. No matter what the time frame you choose to use, it is always advisable to look at the longer-term timeframes, because you are placing a trade and then filtering it down to the time frame you want to use. You do this because a great deal of price action sentiment can be gained from doing so. This is the only way that you will be able to see if trends are developing and trade it accordingly. You may have heard the phrase that the trend is your friend. Well, this is the best way to find a trend, by looking at the higher time frame than the one you want to use and then filtering down once you have established what is happening to price action overall. Example A. Traders can look to the higher time frames such as the daily or weekly charts. Example B. By doing this, they will also be able to see clearly more prominent support and resistance areas which may be observed by institutional traders, because, after all, this is where the real money is. Institutional traders are the ones that move the market, and so it is always advisable to know what they are doing on the higher timeframes. In summary, the type of timeframe that you choose is dependent on the type of trader that you want to be, whether it is a quick in-and-out scalper style or perhaps a longer-term trader. However you do trade, it is always advisable to look at other timeframes, especially the longer-term ones. This will help you gain an overall understanding of the pair and help you to pick your trade entries more easily. Next, we are going to look at trading sessions. The Forex market is broken up into major trading sessions: the Sydney session, the Tokyo session, the London session, which includes Frankfurt, and the New York session. The Forex market is open between 10 p.m. Sunday evening GMT and runs all the way through until 10 p.m. GMT Friday. However, the main centers will typically open around 7 a.m. their time and finish around 5 p.m. In other words, business hours. And where we can see on the graph, some of the sessions overlap. The more the centers overlap means that there are more players in the Forex market at that time, and this means extra volume and liquidity, and therefore greater moves in price action or potentially happen during these overlaps. In summary, the best time to trade is when two sessions overlap, and most of the volume and liquidity is provided during the London session, which includes Frankfurt, is also known as the European session. This overlaps with New York. This is the time that most activity, generally speaking, in the Forex market happens. Please remember to adjust your trading to reflect the seasonal changes due to daylight saving hours. The middle of the week tends to be the busiest because this is where we find more economic data releases normally. Of course, these affect market volatility. The worst times to trade generally include Sundays and Fridays, especially after the US session, public holidays where markets are thin and volume is low, which means spreads will be at their widest, and also during major news events where the markets can be extremely volatile. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.